Stick around for
Thanks.
David. He's going to have some answers here. And did you have
Yeah,
to
and
do?
Dave, by the way, congratulations. He's a new contributor over at CNBC. So good to
How
have you
much
here,
did
Dave.
that cost you, Dave?
Not too much. Case of no.
Oh,
I'll
that's
tell you
great,
after
man.
the show.
All right. All right. Well, you deserve to be on. You're one of the best technicians I know. And
He really is.
great to have you here. So, why don't you explain to our audience what the Hindenburg Omen is? Is it Hindenburg Omen or Hindenburg what?
Hindenburg Omen, you're absolutely right.
Okay.
Yeah, this is something that it's funny. It's a market signal that rarely signals. So it's not one of those like, RSI being overbought or oversold, which kind of happens all
Right.
the time. This
Yeah.
is actually an indicator that was created decades ago
Yeah.
by a study of major market tops. And so this strategist named Jim Mieko went through a ton of market tops in history and looked for similarities. And he found three basic things that were pretty much common at every major market top. Number one, the market was going up, which makes sense, right? So you look at a rate of
Yeah.
change on the New York Composite Index. Number two is you have new highs and new lows, both at a legitimate amount. So it's not like everything's breaking out or everything's breaking down, but you have some of both, which means there's some indecision. And then the third one is that the breadth turns negative. So the McClellan oscillator, which I think we've probably talked about when I've been on the show before, turns negative, which just tells you the short-term breadth is rotating. So the last three times we've had this signal, and it's occurred, a couple times every 5 years is how I would generally say it. Was at the end of 2021, right before the peak in January, right before the COVID drop, and then this third one was in July, August of 2019. So what's interesting is if you look back at all the major market tops, I'm talking like 2022, 2020, sort of 2007 type of tops,
Yeah.
this pattern occurs. And we actually just had the initial signal last week. Now, one key caveat to that, which I've kind of illustrated here, this is an indicator on stock charts where we track those three components. So if it's at three, it basically means all three are firing at one time. You need to have multiple signals within a month. And that was something he found as well. He found there'd be a lot of false positives that would randomly happen just because something strange would be there. But if you had a couple different times where this occurred over like a 3 or 4 week period, that was a really dangerous sign for the markets. And it usually doesn't happen, or rarely, if ever, happens after a big sell-off. It actually happens before things really get squirrely. So we had that initial signal last week. So you're looking for a confirmation here in the next couple weeks. And if so, that tells you that February into March probably really painful for stocks.
Great explanation. And the example that you're showing there in late 2021, it was a little early,
And that's the
right?
thing,
You
right?
had
This
one
isn't
more.
this isn't
Yeah,
like a day-to-day
right,
timing tool. This is something that
right.
really looks at a structural phenomenon. And so yeah, you even had one more gasp higher before the sell-off really started.
Or how about if it's like that, Dave, and we pull back to say 46 and a half, and then go to 52, 5,300. That would be kind of analogous with what happened that year. You got a 7%, maybe 10% correction, and then you have one more high. We have one more high into the summer.
And that last gasp higher is a really painful stretch. I mean, looking back, it doesn't look that bad, but I
Yeah,
mean, when you have that big, because it sucks a lot of people in, it's a really challenging market because you're making new highs. The momentum is proving there are a lot of individual stocks that are probably working just in that little period. So it's a very tempting market. But Greg Morse, who is one of my mentors, used to say that all new highs are bullish except the last one. So always be
that's great.
looking. It's a good reminder to just remember that it's all about risk management, right? Making new highs is great, but it's all about what happens right after and making sure you have a good risk management strategy on the way down.
I also noticed that we had three of those little like false positives into that zone. And
Yeah.
so far here, uh, to current date, we've only had one.
Yeah, it's an initial signal, but it's funny
Yeah,
as we talk about the dynamics of the market here in Q1, which is yeah, I mean frothy is an adjective that I know a lot I've heard a lot of people use, which I think is fair. The AI trade working just exponentially so. A lot of individual, I mean, just Uber and Lyft just this week, just kind of
Yeah.
popping higher. They're probably going to gap up again today.
How about
Um,
ARM?
all of these. So I think there are a
Yeah.
lot of names, right, that have just had
Yeah.
these really, I mean, just extended moves by any technical definition. And so this is when technical analysts that I know, we're all in the back of our head thinking the Hindenburg Omen's going to signal here pretty soon, probably, because these are the conditions that I remember from late 21 and from 2020 and from 2007 and from 2000.
1921 or 2021?
Uh, fair question. No, we'll keep it. We'll keep it in this century.
All right, David. All right. So why don't we turn towards yields? And I'm curious to see if you have some measured moves after that breakout in the 10-year yield over 420.
Yeah, so it's interesting. I mean, if you look at what's happening with the equity space, obviously, and I would argue I mean, Hindenburg Omen aside, I think that big gap that we saw here this week, I think that's just the beginning. And seasonally speaking, February and especially March are pretty rough months in an election year on average. So not surprising we would have a period of pain. And if you had asked me what happens if a growth-led rally stalls out and starts to retrace down, I would say interest rates are probably popping higher because that is sort of the general way that a growth-led rally starts to die, is because rates go up and that all of a sudden makes it the growthy stuff just is a lot less attractive in a higher rate environment. So I was looking at
Does
this.
that mean mega caps, bro?
Well,
Growth?
so what's interesting is if you think about where investors are rotating right now, this is what's sort of a head scratcher of sorts. The general playbook is if rates are going up and the market's getting defensive, you would see people rotating either to pure defensive plays like REITs and utilities, consumer staples, which you're really not seeing. Those groups are overall still doing quite poorly on a relative basis. They'd be rotating to some value sectors like industrials, financials, and that's where you actually have seen a lot of flows. They've actually done quite
Yeah.
well, but
Last
you're
year.
not seeing big flows away from the big, mega cap technology and communications names. I would argue they're really a defensive play here, right? I mean, the playbook is basically get big and defensive, and in 2024, that means Microsoft and Meta and Alphabet. I mean, those names are going to survive whatever correction we have. So I think part of it is actually more of a defensive play than you'd think, and investors getting to defensive blue chips. It just used to be Pepsi and Walmart. Costco's doing quite well, but I don't know if that's exactly what I'm thinking. But I think it's the defensive nature of those big kind of quality growth names are what
They
we're seeing
become
still.
bonds.
In a lot of ways, right? Bonds with not a
Yeah.
particularly great coupon, but with a good return profile for sure.
I noticed you left out Apple in that mix.
No, and Tesla, I didn't mention either of those. That's
Yeah.
fair, Dale. And I agree. I mean, but again, this sort of environment is where you start to separate the good for the wheat from the chaff, right? As it
I
were.
love
So
that.
so in
Yeah.
an everything rally like we have in January, in December, like everything's kind of working. Trucking companies, railroads,
Yeah.
banks, growth stocks, value stock, everything's kind of working. Now things start to evolve a little bit, and you see on a big down day, Nvidia almost finished in the green yesterday, right? I mean, so
Yeah.
so you're seeing which names are really the quality names and which ones were just kind of part of it. Apple's starting to not be part of the shrinking number of Magnificent Seven stocks, I would say.
There's a worm in the apple. Huh?
So on Yieldsdale, I would say that if you look at how I've labeled this, if you know
Yeah.
charts, which I know a lot of the viewers do it, I was labeling this as a bear flag pattern, which is what it certainly
Yeah.
looked like, right? So you have a big downtrend, and then you have
Yeah.
this parallel channel coming up,
Right.
and then you broke it.
Breakdown.
So my
Yeah.
playbook says, all right, that means yields are going way lower, and it measures actually outrageously low, unreasonably
Money.
low. So I'm thinking, all right, this says
Yeah.
bonds are rallying, but if you look 2 days later, we come right back into the
Yeah.
pattern. And that's when you have pattern analysis like this, one of the great tells I think you'll ever have is a failed breakout or a failed
Yeah.
breakdown, right? There's a
Yeah.
certain pattern that you think is confirmed. There's a move that you're expecting. And then the opposite happens when we get back in that pattern. That often tells you, okay, that's a false basically a false positive, and we're probably moving back in that other direction. And I think that's what we're seeing here. So I think, from a technical perspective, I think we're rebounding back into this range. And the way that I would be thinking of it, and I'll do it as we're talking here. The way that I would think of it with this kind of move is you immediately pop these on here. And so what's interesting is just yesterday we broke above that first objective, which is around 4.25, we'll say,
Right.
which means I'm looking up to 4.5, which would take us sort of to the lower end of this sort
Yeah.
of consolidation up here at the top in October.
Got it.
And
Okay.
again, that if you think about the seasonality, which is February and March are quite weak. Growth stocks, which have had an incredible run, and anyone that's watched these stocks go higher will tell you they need to have a pullback to digest those gains. So, 10-year going up another, let's say a couple, 20 basis points is not unreasonable to sort of complete that total narrative. And then I think, like you mentioned with the previous chart as I was jumping on, I think then with the dollar, I think once you get to that point, then you reassess and then you see how much have stocks pulled back. Is that at an important level? How much have rates gone higher? Is that reasonable given where we've come from? And then you see where we go next.
Okay. So great analysis. So the dollar going with yields. Should we be looking for a place just like the yields could, just retrace? The dollar looks a little bit stronger. Are we going to challenge those highs at 107?
So this
We're
is
right
one
in
of
the
those
zone.
times. Yeah, this is one
Yeah.
of those times. It's a little counterintuitive, but I would say from a technical perspective, both the dollar chart and the yield chart look pretty good at this point. But
Yeah.
I think, I'd highlighted this 105 level. You were talking about
Yeah.
that with Blake. This actually, it's interesting. This is actually a longer term level. This comes from that big run from late 2021 up to the peak in 22. This is a 38.2% retracement down, and that's where a number of things have happened. And so we're kind of right back at that point. I'm looking at
Yeah.
107, which is the peak here in October. Now that we've sort of cleared this most recent resistance, I think from a
Yeah.
technical perspective, you're kind of getting to the upper end of where you might expect resistance. So I have the luxury of being a little more longer term than I know, some that are listening here. But I mean, for me, I usually have this as like a shaded area and
Yeah.
kind of think this is the general place where you expect the dollar to kind of top out and then roll over. We're also nearing that overbought condition, which is
Yeah.
where we've been at these previous peaks. So it's sort of lining up that we're kind of near the end of this move. So I would think of it more as like we're in the 8th or 9th inning and not the 3rd or 4th inning.
Got it.
So the time to start to think about dollar weakness, but it's not yet. It's sort of nearing that point, if that makes
Traders,
sense.
take note how far left Dave goes to find these levels.
Yeah,
Take note.
I think that's fair. And to be honest, I mean, having worked with a lot of traders, I think there's a lot of times you have the blinders on and you're thinking about your short-term environment, which I think
You're
is
looking right. Yeah.
you're looking to the right and you're thinking to the right. But what you have to remember is there are a lot of accounts with a lot of zeros that are driven by levels way off to the left. And so starting sort of macro and going micro, could be a nice way to upgrade how you're thinking about things. And then you're not surprised when certain levels have meaning because there are a lot of, longer term accounts that are being managed off of longer term levels. And I think that can be really helpful to just understand the dynamics in the short term.
So, Dave, I noticed that the RSI structure and the relative strength in the Dow has been the weakness. It on the daily is on its 50-day moving average, while S&P and NASDAQ are way above it. What
Yeah.
is the reason, technically or what fundamentally, why the Dow would be demonstrating more relative weakness than the other indexes?
No, that's a really good question. So, so I'm showing on the dashboard. We have 3 of these listed, right? The Dow, the S&P, and the Nasdaq,
Yeah.
and then mid caps and small caps. I would kind of probably put in that bucket of like 5 things. If you want to understand what's going on with equities and leadership themes, you look at those 5, and whichever ones are struggling versus the others will tell you which types of names, which areas of the market are doing better. So what you have to remember is the S&P, while a broad measure of 500 stocks, it's really not that broad. So I mean, at this point, the top 10 stocks, the Metas, the Apples, the
Yeah.
Microsofts, those top 10 stocks are currently the same weight as the bottom 420 S&P stocks. So one of those names moves up or down, and that dwarfs, 50 to 100 other names doing something dramatic. I mean, that's how big of an outsized impact they have just because they've gotten so big. And there have been, previous market cycles where names have been this big, but this is one of those times where it's exaggerated. It's more than normal. It's more top heavy than normal. So the S&P is trading a lot like the Nasdaq because they're both dominated by the same mega cap growth stocks. The
Right.
Dow is a little broader representation, even though it's a smaller number of stocks, it's a broader representation of sectors. So you have industrials and you have banks and you have,
Okay.
things that are not growth stocks in there. And so when you're looking at the Dow stronger than the Nasdaq, which is kind of usually what happens is the Dow or the Nasdaq is at the top on a given day, and then the S&P is in the middle because the Dow is going to represent the value trade, the Nasdaq's going to represent the growth trade, then the S&P is, more like the Nasdaq, but kind of in the middle.
Yeah.
Is generally it. And so what happens when you have the AI frenzy growth
Yeah.
dominated market, the Dow's going to lag, and that's kind of what we're seeing here.
So
The
the Dow is more representative of the whole market with fewer stocks.
which is so hilariously
Yeah.
counterintuitive, but it's absolutely
Right.
right. I mean, it's because of the sectors and because of the weightings now. And then the other one is, mid caps to a degree, but small caps especially, because small caps really are the heaviest sectors in small caps. It's things like industrials, financials, healthcare. And so small caps are way more representative. It's a mix of value-oriented sectors that I mentioned, so like regional banks, for example, but
Yeah.
then also speculative, like emerging technology that isn't big enough to get into mid caps or large caps yet, so they're still small. So it's sort of like this weird mishmash of things. But when small caps are doing well, if you look at any given day, that usually means regional banks are popping, industrial companies, sort of those non-growth sectors are starting to rally because they're just overrepresented in the small cap space.
Okay. Is it time, despite what the dollar's doing, to look overseas? I know Gunlich brought up India. He loves
I think,
India.
yeah. So I think opportunistically, right? I mean,
Yeah.
I think when you're thinking of an allocation, I think you have two choices outside the U.S. One is you opportunistically look at where there's strength, and I
Yeah.
think I mean, the
I
exciting
wouldn't buy
thing.
that.
I would too.
I
And I
wouldn't
don't
buy
own
it.
it, but I would. I mean, this is the type of chart that's really good. When you look outside the U.S., something like India, Japan,
Look at that
strong charts
divergence.
and good setups. This is INDA, which is a U.S. listed ETF. You can look at the local indexes like $ Nifty on our platform or the Sensex.
Yeah.
And in local terms, they've done even better. But yeah, INDA is the India ETF that I track. And it's pretty good. I mean, if you covered up the ticker, you might guess it's a semiconductor name in the U.S. because it has a
Yeah.
very similar look to it. And so I think it's a pretty good place to be.
How about Mexico? Because the peso is trying to peak out here, and markets seem to do better with the weaker currencies, more risk on. How's Mexico look?
So Mexico has actually been one of the better non-U.S. markets that I would probably highlight. What the concern that I mean, from a technical perspective, here's the problem with
Yeah,
Mexico.
double top.
Yeah, which is the problem with a lot of things, actually. You have it's called a bearish divergence, right? We have,
Right.
essentially a double top pattern around 69. This is the
Layering
EWW, which is the
divergence.
Mexico ETF. But look at
Right.
the weaker momentum, right? So
Yeah.
overbought in December, and then we retest the highs on weaker momentum. A lot of US stocks have this similar sort of look, which is, going into this week, I was probably way early at talking about a meaningful pullback, but I'm not surprised that we're seeing it this week because you have all these classic signs, market going higher, and then a lot of measures of momentum and breadth, especially coming lower. So Mexico looks like a lot of U.S. stocks that are moving higher, but the momentum has been dissipating in February.
Okay, Dave, why don't we wrap it with going to the dark side? And tell me what you think about VIX and its 1 day pop where we got to 18 and then closed at 15. I think some vol guys got squeezed pretty good yesterday. I happen to not think it's over.
Yeah.
Wondering what your take is because I still think even with yesterday's 100 handle decline in S&P that there's still a lot of exuberance.
When
because
you
it's,
said the dark side, I thought you were going to ask about the Fed, or so I didn't know where you're going to go.
oh yeah,
Economic data. I was like, oh,
we're not
what's the
gonna
dark side?
we're
Okay,
not
we're
gonna
not
go
there.
to
Good.
Jekyll Island, man.
I,
I mean, I don't want to go that dark, but I'm
no, so I
curious.
no, I think that when you have a market that's been so strong, what I think of are what are those like release valves, or what are those red flags that you would see? Because we've had this just relentless climb. Here's the S&P on the bottom
Yeah,
half here. I mean, it's just been a nice, consistent uptrend, right? So what would you look for that would tell you conditions are worsening? And the two
higher
things that
lows
well, so the two
in the
things I mean,
VIX.
besides just the price, which is totally fair, right? I mean, as long
Yeah,
as we keep making higher lows, we're good. So if that stops, that's fair. So
yeah,
S&P below like 4850, that's a different type of discussion we'll probably have.
yeah,
But the two other things would be a spike in volatility, and then the third one would be decline in breadth, like a meaningful decline. And I would argue we're seeing both of those things. We're seeing a spike
okay,
in the VIX and a decline in and a decline in breadth indicators. With the VIX, I kind of think of the VIX as like three different points, and I've kind of highlighted them here. What we've been in is a low volatility rally, right? So the market's been
right.
going higher, and the VIX has been in the low teens consistently here, right? And since
Yes,
mid-November, it's been 12 to 14. So the VIX above 15 is sort of your initial warning. We're not going up at the moment. We're now going down. And that's kind of what yesterday was, I think. That initial, this could be something more. Now, how do you tell it's something a lot more? The VIX needs to spike up above 20. And that happens occasionally during a big meaningful drawdown. So we got there in October. But also, if you go like way off to the left, like early 22, when things really get rough, the VIX gets above 20 and then just keeps spiking. And then that's when you know, okay, this is not just a brief pullback. This
yeah,
is a really painful drawdown. And then 2850 is the line I'm highlighting here. And this actually comes from Ned Davis research, which some of you guys might be familiar with it. Ned Davis, I mean, a famous market tactician who's been publishing for decades. And I know in the institutional community, we followed him closely. They did a deep dive on the history of the VIX and what really differentiated a garden variety, buyable pullback kind of market and you really need to get defensive because things are getting really bad environment. And for them, 2850 ended up being the best number. So I have that on here as like the point of no return. If you're still long and the VIX is above that level, you're wrong, and you need to admit it at that point. So this is the way that I think. I mean, we've had that initial warning, which is we're not
yeah,
going up. VIX above 20 is this is getting pretty painful, and you need to really think
yeah.
about risk management. VIX above 2850 is look out below and buy utilities or cash and just wait it out.
Dave, this is why I love doing these interviews, because if you take the first rally in the VIX that we had into the October low, it was 12 to about 22, 23, about a 10-point advance.
Yeah.
And we took out those lows, and I think it's an irregular B taking out those lows, and a C is underway, which could, if it's 1.618 of A, that would be 16 handles from 12, gives you 28.
That's interesting.
Huh?
There you
Man,
go.
it's confluence from different things. And when I see
I love
these
it.
things, it really, what a great interview, David. Really great interview. I just think that people have to follow you. And, I love your work. And I just want to, show your website so people know how to get to market misbehavior. Here it is. And this is the best way to get a hold of David. You could also find him on X at DKellerCMT. And you could also hear him. You're everywhere on the final bar on stockcharts.com. And again, congratulations for CNBC finally waking up to bringing in a great technician. So
No,
you and Katie Stockton are now my favorite technicians on
there we
CNBC.
go. No, I
Yeah.
appreciate it. Always a pleasure. I hope we can do it again soon.
All right. Dave Keller, everybody. Hope you enjoyed it. Definitely added value to my narratives today. So thanks, David, my trading warrior brother. And
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.